Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And we begin today in North America, but not with the US. We are north of the border. This week, the Bank of Canada delivered its first interest rate cut in 6 months, responding to mounting signs of economic weakness and labour market strain. Policymakers reduced the benchmark overnight rate by a quarter point to 2.5% in line with market expectations, but stopped short of signalling a clear path for additional easing. Central Bank Governor, in a statement, admitted, quote, "With a weaker economy and less upside risk to inflation, Governing Council judged that a reduction in the policy rate was appropriate to better balance the risks going forward." End quote. He noted that while there was clear consensus for the decision, officials had also weighed keeping rates unchanged. The move comes as Canada's economy reels from trade disruptions. Officials highlighted the loss of more than 106,000 jobs over the summer, largely concentrated in trade-sensitive sectors such as auto, steel, and aluminium, or aluminum for our North American friends. Hiring momentum elsewhere has slowed as well, pushing the unemployment rate up to 7.1%. The economy contracted at a 1.6% annualized pace in the second quarter, dragged down by weaker exports and business investment, a painful contraction. The governor acknowledged that while housing and consumer spending remained relatively resilient, tariffs were, quote, having a profound effect, end quote, on key industries. The Prime Minister, Mark Carney's recent removal of retaliatory levies on some US goods has reduced one source of inflationary risk, but trade uncertainty continues to cloud the outlook. At the same time, Ottawa is pursuing a fiscal path that diverges from the austerity seen elsewhere in the G7. The Prime Minister confirmed in recent days that his government will run a, quote, substantial, end quote, deficit this year, exceeding last year's 48 billion Canadian dollar shortfall. The plan channels billions into defence spending and affordable housing projects, aiming to support industries battered by tariffs and reduce Canada's long-term reliance on US demand. Carney has emphasised that Canada's relatively strong starting point, net debt of just over 40% of GDP, the lowest in the G7, and top-tier credit rating gives Ottawa room to manoeuvre. For now at least. While bond markets punish the UK and France for fiscal indiscipline this year, Canada's position looks less precarious, though economists expect the deficit to rise above 2% of GDP. The Prime Minister has promised a balance of, quote, austerity and investment, end quote, with operational revenues of public sector spending and procurement reforms meant to offset the new commitments. Still, some analysts are sceptical. Ottawa's proposal to split the budget into capital investment and operating costs has drawn criticism as little more than optics, with outlays still requiring financing. For the Bank of Canada, fiscal expansion adds another layer of complexity. A looser budget stance may help cushion the downturn, but could also reduce the urgency for aggressive monetary easing. Quote, the Bank of Canada remains in a bind as it weighs the upside risks to inflation against the downside risks to growth from the trade war, end quote, economists at Oxford Economics noted this week. The near-term outlook hinges on how trade tensions evolve, with another rate decision looming in October and a fiscal budget expected soon after. Monetary and fiscal policy will now be working in parallel to navigate Canada through this painful economic turbulence. Next up, we move to Asia. China's youth unemployment crisis deepened in August, highlighting the strain on an economy in the midst of structural change and, many would argue, including myself on my other channel, China Update, structural decline. The jobless rate for people aged 16 to 24, the youth unemployment rate, excluding full-time students, rose to 18.9% from 17.8% in July. Data from the National Bureau of Statistics has showed. It marked the highest level since the agency introduced its new methodology for tracking youth unemployment in late 2023. At that time, Beijing had pulled the data as it was so high that it was causing both embarrassment and concern. Even under this new methodology, however, the youth unemployment rate is surging. The increase comes as a record 12.22 million graduates enter the job market this year, 430,000 more than in 2024. The influx of young workers has coincided with retrenchment in industries that once reliably absorbed new talent, exacerbating competition for limited opportunities. Quote, campus recruitment demand is still in a contraction phase, especially especially in real estate, internet, tutoring, and financial services, end quote, said Mao Yufei, a researcher at Renmin University's China Institute for Employment Research. Now, some may be asking, wait a minute, I thought China was going through a population collapse. How is it that the number of graduates every year keeps increasing? This is a fair question, but easily explained. While the number of young people as a percentage of the population is decreasing over time, the percentage of high school graduates that are also going to college is increasing. This is to be expected as China previously had very low percentages of its working force going into college. Currently, this increase in the rate of folks going to university is faster than the shrinking percentage of youth in the population, and as such, despite the population being in decline, the number of graduates is still increasing. Now, we could take a step back and look at the broader backdrop to all of this, which is a mismatch between China's evolving economy and the skills of its expanding graduate pool. White-collar sectors like technology, real estate, and private education, once magnets for ambitious young job seekers, are scaling back amid regulatory pressure and shifting growth priorities. Meanwhile, new industries such as green technology, advanced manufacturing, and healthcare have yet to fully compensate for the decline. Evidence of the imbalance is clear in recruitment data. Internal figures from a major job platform obtained by Chinese financial media outlet Tariffs showed postings for college graduates plunged 22% in the first half of 2025 compared with a year earlier, while the number of job seekers rose 8%. Many young people are postponing employment, seeking additional degrees, or turning to gig work as a stopgap. In a concerning piece published by this financial media outlet in China, Caixin, yesterday, the Chinese authors observed, quote, "The numbers point to a worsening structural imbalance in the economy. Long, reliable, white-collar sectors like tech, real estate, and tutoring were scaled back amid broader structural adjustments, just as an unprecedented wave of skilled talent floods the market. The mismatch is leaving many graduates in cutthroat competition for a shrinking pool of attractive roles or pushing them to delay entering the workforce. With annual graduate numbers expected to exceed 10 million through 2040, the trend could leave swaths of young talent on the sidelines and weigh on economic performance for years to come." End quote. Now, policymakers face mounting pressure to expand employment channels and accelerate the country's transition towards sectors capable of absorbing skilled labor. Failure to do so risks leaving a generation underutilized, with long-term implications not just for productivity and growth, as this piece points out, but for social and political stability too. For now, the surge in youth unemployment stands as a stark reminder that China's transition to a new growth model is both necessary but also fraught with social and economic dangers. Now, if you want to be on top of the most up-to-date analysis on the biggest developments in the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. If you're getting some value from today's episode, don't forget to hit the like button, and there is a Buy Me a Coffee link in the description below if you'd like to go the extra mile and help keep this channel, an independent channel, financially sustainable. I rely primarily on your support to keep going, as this is a big help too. Thank you so much. And finally for today, we go to Europe. With Ukraine under siege and Russia pressing its military and political advantage, no country is more at stake than Poland, sharing more than 300 miles of border with Ukraine and another 250 with Belarus. Warsaw is acutely aware that if Kiev falls, it could be next in line. Yet rather than buckle under the pressure, Poland has surged to the forefront of Europe's economic landscape. For the first time since joining the European Union in 2004, Poland has emerged as the bloc's growth leader. The country's $915 billion economy is projected to expand 3.3% in 2026 and 3.2% in 2027, more than double the expected EU average and pushing the Eastern European country to $1 trillion GDP annually. Since 2017, Poland's GDP has soared 93%, far outpacing, for example, the UK's performance. The transformation is not just about growth rates. Household consumption has leapt 125% since the UK's Brexit referendum in 2016, triple the Eurozone average and far ahead of major economies such as Germany, France and Italy. At the same time, a reverse migration trend is underway. The number of Poles living abroad fell to 1.5 million in 2023 from a 2017 peak of 2.54 million, as many skilled workers, teachers, healthcare professionals, engineers returned home, bringing expertise and wealth back into the domestic economy. Markets have taken notice. Poland's currency has been the best performing emerging market currency since Russia's invasion of Ukraine in 2022, appreciating 14% against the dollar. In fixed income, Polish bonds returned 31% in recent years, outperforming debt issued by Germany, France and the UK. The Warsaw Stock Exchange has surged as well, with the main index up nearly 50% in 2025, driven by a powerful rally in financial institutions. This is an outstanding performance. Some argue that Poland's success story is a vindication of the EU's single market, which allows the free flow of people, goods and capital, or at least it has been great for Poland. Regardless, what is clear is that Poland is fast becoming one of the continent's great economic pillars, an asset when its neighbourhood in Eastern Europe is increasingly unstable and of regional and indeed global concern. Okay, that is today's episode of Market Update and this week's final episode. Thank you so much everybody for watching. Have a good Friday, have a restful weekend, and I will see you for a new week of updates on Monday.